It's a pleasure to be here in front of you all. I'm Troy Donahue. I work at BTIG on the global portfolio and ETF trading desk. So more specifically, I work with pension plans, registered investment advisors, investment managers, ETF sponsors to help them implement their various investment strategies. ETFs have long been a pillar of those investment strategies, but now with the growth of actively managed ETFs, there is even more optionality for the investment community. So today we'll start by talking about the growth of actively managed ETFs, and then we'll dive into what some of the benefits that these actively managed ETFs provide over some of their counterparts, whether it be passively managed funds or even mutual funds. And then we'll finish off with a little bit on product design and what these panelists thought about when they were designing their actively managed ETFs. So we've got a great panel here today. 4 talented individuals that are all experts in the ETF actively managed space. So without further ado, I'll let them each introduce themselves, starting with Brian here.
Hi, I'm Brian Kelleher. I'm with Simplify ETFs, Simplify Asset Management. We're a relatively new ETF issuer, only about 2 years old, but been growing pretty quickly, up to about $1.6 billion across 25 different strategies, all of which are active. So big proponents of the ETF structure. Everything we do is ETFs right now, and big proponents of active.
Hi, I'm Tim Coyne, head of ETFs at T. Rowe Price. T. Rowe Price, very large asset manager. Our ETF business is still fairly young. We launched our first ETF in 2020, and I'm a huge proponent of active ETFs as well.
Good morning. I'm Matt Berry, head of capital markets for Touchstone Investments. Touchstone is about $24 billion investment manager. We are distinctively active, fully active strategies, historically offered in mutual funds. We launched our first 4 active ETFs a little over a quarter ago. We've got about $200 million across those 4 ETFs today.
Good morning, everyone. Fred Edwards, Neuberger Berman, an ETF specialist, basically multi-channel sales overlay. Neuberger entered the ETF market in April of this year. We've got 4 products, roughly $225 billion in AUM. Million, excuse me.
Wishful thinking. So we are the last panel before lunch, so we'll just dive right into this and get it started. I'll give a quick background on the growth of actively managed ETFs, and then we have a good panel that we'll rely on to go from there. So as of today, there are nearly 1,000 different actively managed funds. In total, that makes up $330 billion in assets. It might sound like a big number, and it is, but in the grand scheme of ETF assets, it only represents about 5%. So you can tell that actively managed ETFs are going to be a big growth story as they take more and more of that market share. And we're starting to see that this year. Year to date, there's been 226 new products to come to market as of today. And new entrants are continuing to enter the space, similar to Touchstone and Neuberger. So one of the big reasons for the growth in actively managed ETFs was, and it was touched upon on a couple of the other panels this morning, Rule 6011, which was a big catalyst for the growth and innovation. So I'll ask Brian, commonly known as the ETF rule, what advantages did that give to actively managed ETFs, and more specifically, Simplify?
Yeah, so I guess a little bit more about my background. Prior to joining and launching Simplify, I was with PIMCO for a decade, which was definitely a pioneer in the active space. And the ETF rule was huge change for the industry. Prior to the ETF rule, it was really, and it was really difficult for an issuer to set themselves up. It was timely, it was time consuming, it was expensive, just a very opaque process, there's a huge bottleneck. So the ETF rule, number one, made it easier to kind of set yourself up as an ETF issuer and get ETFs to market. Getting ETFs to market used to look like you'd file for something after a lot of back and forth kind of before the filing. You'd send it to the SEC, you'd wait a couple months, you'd get some response. There was this back and forth. It would take like a year. Very expensive, very opaque process again. And it was limited with what you could do in the ETF structure. There's moratorium on derivatives, very limiting. So the ETF rule right now for Simplify, a new ETF issuer, we can come up with an idea, work with our lawyers, come up with the filing. We can file and be trading 75 days later. And it's a very clear process. There's still a back and forth with the SEC. It's not cheap still, but it is a very efficient process, particularly when you consider what it used to look like. And then the last thing specific to active ETFs, the custom basket for creation redemption was a huge advancement, right? Because prior to that, it was either everything in kind, pro rata, or cash. So having the ability to change what's in your basket coming in and coming out for an active manager is really, really critical. So for us, we've got 25 strategies. All of them are active and varying degrees of active. It can be a fully stock pickers portfolio like our Pink, which is our kind of nonprofit ETF. We give 100% of the proceeds to Komen. It's an active stock picking portfolio to something like SPD, which is mostly beta exposure, but we're managing a protected put overlay, and that needs to be active.
Great. So it's pretty clear that the ETF rule created greater innovation and competition within the space. Definitely a benefit for actively managed and all the different products that came out because of it. Some of the products are active transparent. Some are active non-transparent. So I was going to ask Tim if he can talk a little bit about the differences between active transparent versus active non-transparent and where T Rowe sits in that ecosystem.
Great, thank you. So we offer both semi-transparent as well as fully transparent products. I try to shy away from the non-transparent because there actually is disclosure with semi-transparent products. And I would say that the similarities between the two are they're ETFs. It's the same structure, they're listed, they trade on exchange. All the same benefits that are derived through the ETF structure are derived through both active transparent as well as active semi-transparent. I think the main differences are when you look at what's available to be launched through the semi-transparent model. To date, the only thing that regulators have approved are U.S. listed securities, so essentially U.S. equities or listed ADR. So there is limitations with respect to what you can deliver essentially through that mechanism. The second thing I would say in terms of the main difference is the disclosure, where most or transparent ETFs, which do fall under the 60/11 rule, provide daily holdings file of their of the underlying constituents within the ETF. So it's fully transparent. Semi-transparent, on the other hand, typically the full disclosure of the portfolio is done on a monthly basis or a quarterly basis. We do it on a quarterly basis, the same schedule as our mutual funds. However, there is a lot of information that we do provide throughout the day. For example, each morning we provide a proxy basket, which is highly correlated to the fund's holdings. On average, it's anywhere between 90 and 95% correlated to the actual fund holdings. So that's number one. Number two, we do calculate and disseminate an intraday NAV, which actually every 15 seconds. That's based on the actual fund holdings file as well. So you get a better sense of where the actual price is trading in the market versus the actual value of the securities in the ETF. And then thirdly, at the end of day, we provide metrics on our website where you can go in and you can actually see the tracking of the proxy basket relative to the underlying portfolio holdings. So there is a fair amount of information we provide. And I will say that while we do protect our investment IP, that's actually coming from a good place. All of our equity strategies are based on existing strategies that are delivered through mutual funds, SMAs, et cetera. So in many cases, these are very large strategies, and the protection is really important around when you're entering into a new position or you're exiting out of an existing position. Specifically, because of our size, it may take multiple trading days to actually establish that position or to trade out of a position. And if we are providing that information, it doesn't just impact the ETF, it would impact basically that security and valuation. It opens up to front running, essentially, for other market participants, which would increase the cost for our trading, which would degrade alpha generation over time, which is not a good result for T. Rowe Price shareholders. So it's actually coming from a very good place. And I think in the approval process for semi-transparent active ETFs, that was the major question. I think everyone kind of gets the reason why you would want to protect IP from front running or free riding of your portfolio. The question was, how are these products going to trade? Is there enough information for market makers to effectively and continuously quote tight spreads on these products? And the answer is yes, and we have a lot of data to support that. On average, our equity ETFs trade in line with fully transparent passive large cap ETFs. So I think there's that worry that existed prior to the approval has really kind of melted away. And increasingly, we're now having conversations with clients about the strategies versus the structure, which I would say the first 12 months, 18 months after we launched, a lot of the conversations with advisors was really to better educate them and answer their questions around the structure, right? It was something new, but now I think we're kind of getting past the structure a little bit, back to like the value of the fund itself.
And it's clear education is very important. So forums and panels like this help to educate the different investors to the concerns that they might have to make sure that these products can be successful and have the types of assets that should be driven by the strategies. So it is clear multiple different sponsors are looking to utilize the ETF wrapper, whether it's active, transparent, or semi-transparent, but they want to have an ETF solution. So recently, I'm starting to see more and more sponsors trying to mimic mutual funds in an ETF wrapper. So I'd like to ask Matt just to talk about mimicking some of the ETFs via the mutual fund and how you think about that.
Yeah, that's certainly a trend we've seen a lot of this year and continues to increase. So for Touchstone, our first 4 ETFs are all similar to, but not necessarily identical to, corresponding mutual funds in our active roster. And the reason a lot of issuers are doing this is pretty simple. They want to put their best foot forward. You know, demonstrated team, investment process, demonstrated results, and package that and marry it to the benefits of the ETF vehicle. So marry it to the tax efficiency, flexibility, and other benefits that we're all familiar with. What's interesting is you're seeing a couple different routes the managers are trying to use for this. Some are going the full clone route, the exact same strategy, just 2 different vehicles, mutual fund ETFs. Other managers are doing I'd call it a near clone, where it might have called a 5, 10, 15% difference, some sort of difference in sector exposure or a more concentrated version or credit quality if it's on the fixed income side. And the reason for that is because a lot of the broker-dealer platforms, the wires and the independents and regionals, really express a lot of concerns about having clone products and a mutual fund and ETF live side by side in their platform. So there's a few different ways to go about that. I think what's important for advisors is to understand what they're getting. Is it an exact clone or is it different? And if it's different, how so, and how should that impact their expectations?
Got it. So Fred, with all those benefits that Matt's talking about, is it possible to convert a mutual fund into an ETF? And if so, what are some of the challenges that a sponsor might face in doing so?
Yeah, sure. So, just given the amount of issuers and issuance out there, the legacy asset managers are looking into converting mutual funds. And, Neuberger launched their franchise in April. And, self-seed, $5 million apiece. But, how can we kind of, enhance this and enhance this quickly? So we recently converted a commodities mutual fund, 40 Act Cayman sub. Track record back to 2012. $200 million. And I think, for those of us in this room, it makes sense as to why, this was the first conversion we did. The asset class is hot. It's generally more tactical in nature. So, the ETF makes a lot more sense. But like many out there, I think there's only been, 30 or 35, conversions to date. And, we're kind of new to the business, generally speaking. And, the firm had looked into ETFs for quite some time, and we didn't launch till 2022. So it was kind of a rapid fire learning process for us. And I think the important thing to consider is not just should we do it, but A, how does this work? What are the resources we need internally? And then you have to ask the questions about your counterparties, and that's first and foremost, it's existing clients. So you want to retain the AUM, we all know that, but does this work for them? As a fiduciary, does this work for them? And the fact of the matter is that's kind of a greater good scenario, but on balance, does this work better for clients? We reduce the management fee, so at least from that perspective, we had something to talk about right away. But interestingly enough, our individual case study, Neuberger still has direct clients, folks who, I was introduced to, who fax orders in for mutual funds. And, we're talking about an ETF conversion. So, everything from that to the operational piece. And, for those in the room who are considering it, I think, existing clients, potential clients, does this make sense? But also, you don't want to stretch your intermediary partners. And, this is still new to everyone. As I mentioned, we're still 30 to 35 mutual fund conversions. And I think the whole industry is kind of, learning about this. And we're asking the intermediaries, hey, does this make sense? And they're like, yeah, I guess so. We can do that. And then there are other, custodians and intermediaries who don't handle ETFs. So you have to figure out, what do we do with that? And, just kind of anecdotally, we had a custodian who had $6,000 in the mutual fund, and they didn't redeem on time. And we had $6,000 stuck in State Street. And, there was a brief moment in time where we thought about, backtracking, reconverting back to mutual fund as the only possibility. And, I almost had a panic attack, right? And I think some others, at the firm did. Ultimately, we figured it out. But the point of the story is it can be done, but it's still a learning lesson for everyone in the industry.
Yeah, I would add on to that. I mean, I think you nailed it. There's a lot of considerations and complexity involved with that, and I get asked that a lot, even at T. Rowe Price internally. Shouldn't we just convert certain funds to an ETF? And we are considering that. We're looking at that, but you also have to take into consideration, like for example, a lot of our funds, there's 60% retirement accounts. And to your point, how do these clients actually reach T. Rowe Price or that strategy? In many cases, it's not through brokerage, right? So if all of our clients were 100% through brokerage, it might be easier. If it wasn't all, kind of commingled with retirement accounts, that may make it easier, et cetera. So I think it really does come down to a case-by-case basis, and different firms will have probably different approaches and abilities to make those conversions in the future.
And the retirement side is tricky because 401k dollars are just the infrastructure is all set up for mutual funds. You can't do ETFs really in any major way.
And I think also if we're kind of in the nascent phase of that with only about 35 that have converted, that process is going to be streamlined over the course of the next few years, where people see what works, what doesn't work, what we can learn from, as Tim said, and grow from there. So with that, we'll dive a little bit more into product design and what these individuals thought about when they were creating their funds.
I have a question. Are there any tax consequences for the mutual fund holders when you convert to an ETF? Because you have unrealized capital gains and all sorts of crazy things in there.
Potentially, yes. So that's another consideration that, again, I think the client outcome, but you probably have.
Yeah, sure. I'll just speak to the one that we did because, you know, anything is possible. We were actually the first, all of the conversions to date have been in equity or fixed income. This was a commodities futures-based product, so it's slightly different. I can't speak to any others. Obviously, we were concerned about that. It turns out, you know, there were no tax consequences for the end investor over the course of the transition, the conversion.
Thank you.
So moving over more to the product design side of it, we'll start with Brian again. Simplify has 25 products and counting, all actively managed. And can you just talk a little bit about the thoughts that go into deciding on an actively managed ETF versus a passively managed ETF, and what some of those benefits are that it offers Simplify?
Yeah, well, first off, when you're launching an ETF, you've really got to identify where demand is. And that's something I think we've done pretty well. Almost all of our strategies, we've gotten early traction. We just launched TUA on Tuesday, and our rationale there was, you know, this is a trade that we were doing, a number of our guys were doing all the time at PIMCO, and like, oh man, this doesn't exist, let's do it. So essentially it's a 2-year US Treasury future, duration matched to 10. So big pickup and carry, your duration profile is similar, but all things being equal, you should have a better total return profile. And part of our rationale was that PIMCO Trade For would love this in their PAs, and we actually saw that actually start happening today. So the idea of knowing who's going to buy it is so critical, and as we're all getting asked questions from people looking to launch ETFs, always the question back is like, who's going to buy it? Like, well, lots of people, but who? So like knowing specifically who is really important. Aside from that, the structure is really important, right? Is it going to be active or is it going to be passive? For us, it's a really pretty clear choice. Everything we're doing needs some active element, because what we're doing, and one of the things I forgot to mention in my last comment is a big change for us was the derivatives rule, which streamlined derivative usage in ETFs. Right, so it gives us more flexibility to launch things like our interest rate hedge, PFIX. We couldn't have done that, in 2019. We weren't able to, because half of the exposure is via interest rate swaption. So everything that we do has some element of derivative usage. So we've got to do options rolls, collateral management. We've got to we have monetizations. So we really can't do index. Even I mentioned SPD, which is 98% core equity exposure. There's still that tail risk management that we're doing on top of it. So we have to actively manage it. The drawback to active, and I think this has been touched on a little bit, is with the major platforms at broker-dealers. That's, from our standpoint, that's really the only major drawback to being active. It's because once you're active, you get put into a separate category. You get put in the same line as mutual funds, structured products, everything else. You're waiting to get in the door to that full active management due diligence process. Even, again, if it's 99% index focused, it's that kind of little hairy part that they get very concerned about and make sure. So it's an arduous process. So we're 2 years old. There's a couple major platforms we have 0 products on. The more open RA-focused platforms, that's where we've gotten our traction. But that's, for us, everything we've done so far has been active and probably will continue to be.
Thank you. So I think a big theme that we're hearing so far through the first couple panels and even in this discussion is innovation. There's been a tremendous amount of innovation in the space over the last 5+ years. We talked about it a little bit earlier with the semi-transparent ETFs, and now even this year there's single equity, single bond ETFs. So my question for Tim, is there any good ideas left?
I think there's always good ideas, and I'm always surprised. I think 10 years ago people were asking, is the ETF market saturated, and clearly it's not. I think in the active space, we really are very early innings, and I see it as kind of a whole new segment of the industry being formed. And some of the stats that you quoted at the top of the discussion, I think speak to that, right? The number of products that have been launched over the last 2 years. I think it's something like between 50 and 60% of all new launches over the last 2 years have been active products. I think that also if you look at active in terms of like how it built, it was kind of the reverse of the passive industry where active was really fixed income, and I think PIMCO was a leader there, et cetera. But equity assets have caught up, and of that 320 billion where we are now, I think it's more evenly split where it used to be predominantly fixed income. So I do think there's a lot of runway there, even in core categories, right? And the way that we brought our business or ETFs to market was really listening to our clients and what they were asking for. So we started with existing strategies, well-known PMs, well-known strategies that did have the adoption at the major broker-dealers. Now, things have changed a bit, and I think there are two criteria to get adoption on the major Tier 1 broker-dealers. One is the approval for semi-transparent. There's only been 1 out of the 8 large broker-dealers that have actually approved semi-transparent for use or for consideration, then approval, and then the ability for their advisors to use. And then the other is the clone issue. All of our products are based on existing strategies, and because of Reg BI and other considerations that, and some of it I think is just, they need to build systems from a compliance standpoint to ensure if you have the mutual fund and the ETF based on the same strategy that they can evidence that they're acting in the best interest of their clients. So I think you'll also see, so again, I think fixed income, generally speaking, we're hearing a lot from advisors. There is a preference for active over passive, and you can see certain asset classes where that's true. We actually launched a product today, a floating rate product, but if you look at the floating rate senior loan kind of area, the largest product in that category is actually an actively managed ETF and not the passive. So I think also a lot more precise and client outcome type products will be continued to be delivered. Downside protection. I think there'll also be you can capitalize on kind of macro themes that are emerging. Income. It's interesting, more strategies that are starting to incorporate options, right, where you can actually enhance income streams for investors, et cetera. So I think in the next 5 years, I think you're going to be rounding out kind of the core categories within active, and then simultaneously you're going to see a lot more kind of precision or precise products that are being.
The other thing that you're seeing is that there's definitely a pretty significant part of the advisor community has a structural preference to the ETF, right? So things 10 years ago they would have half of their account would be mutual funds, half of their account would be ETFs. More and more of those advisors, their default option, okay, is there an ETF for this? And they keep looking, and then if they just absolutely have to do a mutual fund, they will. But their preference would be ETF. So that's where a lot of the innovation will be. Is okay, what exposures don't exist or maybe not good enough. We launched a managed futures product, CTA, earlier this year. Managed futures, there's just a dearth of strategies out there in the market. DBMF is a great one that we're frenemies with. But we're 7 months old now. It's a $250 million strategy, and it's a great strategy, yes. But that speaks more to the idea there just wasn't good product out there. There's tons of great products in the mutual fund side, but those advisors that have that ETF preference, that's what they want.
And I tend to believe or agree with Tim that we are in the early innings of this, especially on the actively managed ETF side. There's going to continue to be innovation and, like you said, product. Oh, we got a question?
A question for Tim that follows up on
Okay.
Brian's point. What trends have you seen at T. Rowe outside of retirement on the preference for funds and ETFs in terms of sister strategies?
Yeah, I think we are seeing a growing preference for ETFs and the delivery of ETFs, and a lot of times I think even within the ETF industry, it's kind of like active versus passive, and most advisors are using both active and passive, right? I think what we are seeing is that over time, there is a growing preference for the ETF structure. So the active strategy to be delivered through the ETF structure because of the benefits that are associated with ETFs. So we look at ETFs as a natural extension of our product offering, where ETFs will sit next to mutual funds. And by the way, there are still a lot of clients who like mutual funds, no ETF, or no mutual funds, are comfortable with mutual funds. And there are other advisors who are running both mutual fund models as well as ETF models. So for us, this also gives us the opportunity to expand our client base. So we're delivering for existing clients, and we can expand that current relationship. And then I think, we talked a little bit about the, RIA community where they have full discretion. We're starting to actually see some uptick there as well with our active ETFs. And I will say this, we have some recent wins, which on paper don't make a lot of sense to people, meaning that they chose a T. Rowe Price active strategy that maybe was a bit more expensive, but had a really good, strong track record. They were familiar with the structure. That actually beat out a sub 10 basis point passive product. But the client made the allocation into the T. Rowe Price vehicle.
Yeah. There's another piece to this too, on the intermediary side, and you alluded to this earlier, where the person at XYZ wirehouse or RIA research team who covered ETFs, that was purely passive, and then there was the active guys, and the world is not incredibly efficient and doesn't, adjust in a millisecond. And certain firms, are further ahead in the game than others, in integrating that, because you call, XYZ, I'm not going to name names, and it's almost like the right hand's not talking to the left. And it's, hey, this is a more, uniform wrapper, and, ETFs are, no longer, passive. Or index-based. So, it'd be helpful if, you integrated a little bit more efficiently with, the active folks. And I think on the issuer side, for the active folks, there's some frustration. And for those offering both, index and active, I'd be interested to hear some comments on, what they see in terms of the disjointedness on the other side of the table.
So I'll throw it over to Matt to talk a little bit about his products. So Touchstone is unique in their approach to finding asset managers that are unique and partnering with them to launch products. Can you talk about how you identify those managers and then implement it into an ETF strategy?
Yeah, so investment research is certainly a core competency of Touchstone. We've got 3 research analysts that cover 14 sub-advisors, so about a 5-to-1 sub-advisor to analyst research ratio, which is pretty strong. They do very rigorous research, organizational stability, personnel, investment discipline, infrastructure, and results. And that results in some really world-class sub-advisors. So Ares Capital manages our credit opportunities fund on the mutual fund side, one sub-advisor that a lot of you are probably familiar with. We apply the same rigorous research on the ETF side for our active strategies as we do on the mutual fund side historically. In a lot of ways, that looks the same. There are a few key differences. So one thing that we have to think about that's different on the ETF side is transparency. Is a particular sub-advisor comfortable with fully transparent holdings? If not, for our first 4, we went fully transparent. That might not always be the case depending on sub-advisor preferences and some of the concerns that Tim articulated. Another thing to think about is, I think ETFs will be our base case for new product development in terms of packaging strategies. But there's circumstances where that might not always be the case. If it's very capacity constrained, we might want to preserve the ability to close the strategy potentially to preserve the ability to generate alpha. And then the third thing is really operational processes. So plugging in sub-advisors to the creation and redemption, the in-kind mechanism, that's all unique to the ETF side that we haven't historically done on the mutual fund side. And so there's a lot of work thinking about how do we optimize the tax efficiency and really deliver the benefits inherent in the ETF vehicle in the strategy that we're offering.
Thank you. So as many of you know, 2022 has been a pretty challenging investment environment but one where actively managed ETFs can excel. So my question for Fred is, how does actively managed ETFs help during these different investment cycles, and where can you differentiate yourself from some of the other products?
Yeah, sure. So we came to market with 3 ETFs in April in the thematics category. And while you can argue, there might be some recency bias, and this is late cycle, this is really setting up for the next cycle, because there are trends at play. Take the carbon transition, for example, that are durable. They're very hard to index. We think they're going to continue to be hard to index. And it's about changing leadership. And I think everyone in the room realizes that if you're looking at the marketplace, I mean, take March of 2020. I closed my eyes and bought the Qs. I didn't think about buying anything else. But the next cycle might be different, and the leaders might be different. And I think one of the issues structurally that may be a function of the ETF business is the index is mature, or more mature than it was 2 years ago. So how do you capture a change in leadership? And I think that's what the active ETF is all about, because it's taking a trend, and I referenced the carbon transition. This is a theme we see out to 2050. And there are a lot of components, right? And an active manager and an index provider, all very smart people, could come up with the same solution right now about the best way to position yourself. But I think, thematically, it's about theme not just the individual components of the theme, but management of the theme itself. How is it changing? So the ability to change as an active manager relative to a fixed methodology in an index, we think makes sense, in certain verticals.
Thank you. And I think something I just wanted to go back on, when Tim mentioned that some of their products, even though they have a higher expense ratio, outperform these other products that are sub 10 bips, or even some of the ETF products that are out there now that are zero cost. Is anyone up here getting pushback from clients about the fees that are associated with actively managed? Or is the education now coming around that these can outperform during these market cycles? This is what you're paying for. Because they're still cheaper. I think on average, the actively managed ETF is 69 bips. So that's still cheaper than hedge funds and mutual funds, but obviously more expensive than your historical passive fund.
Sure, I'll take that one first. I mean, I think, just looking back, versus forward, if you're going to do anything outside of index, you're paying up, so you better have, somebody doing your homework for you. Not only that, with transparent ETFs, it's got to be hard to replicate. So we talked about, the buffer strategies, et cetera. You could take an active, strategy and look, oh, what are these guys doing, and replicate it yourself as a retail investor with a small account. So that's the risk, I think, on the active side, is that you can get kind of this, shadow banking scenario where, people are replicating what you're doing. I think the other side of the table is willing to accept higher fees because they understand that, certain funds, there are resources involved in, putting together these portfolios. But, when it was index to index, it was a much tougher question, I think. But I think everyone kind of gets that, active's here to stay. Market conditions suggest, that active managers can outperform, if they want to, but at the right price. So it's not as difficult a conversation, but, folks out there who use ETFs are still fee sensitive.
And there's a higher awareness of fees in general. Like we talk about hedge funds 2 and 20. No one's getting away with 2 and 20 anymore. So like across the industry, fees have come down. So, but to Fred's point, if you're differentiated, you can command a higher expense ratio. Our PFIX, It's an interest rate hedge strategy. We've had clients tell us, you guys really underpriced this thing at 50 basis points, because this is, in order to get access to this type of exposure, you need to have an ISDA, face a bank, you've got to have collateral management. There's all these different things. I mean, it's really exclusive for billion-dollar plus institutions with a robust ops team. So like something like that, that's been the feedback we've got. If you've got something that's differentiated, it can show its value, the market's willing to pay up a little bit more. Not everything needs to be 10 basis points.
Yeah, and I would say too, if you look at passive, quite frankly, there's a pretty broad spectrum there in terms of pricing, from sub 10 basis points up to 70 plus basis points. So I think it also, when you look at certain asset classes, I mentioned the floating rate product today. Like, we're very competitively priced with passive products. With high yield, we launched that a couple of weeks ago, and we're 8 basis points, I think, higher than average high yield passive products. So I think there are certain areas where active is going to compete very closely with passive, and then I think it all comes down to the value proposition and the firm and the products that you represent to clients.
I think it varies by the type of client too. So a lot of our early interest is going to come from believers in active management, people that have used our products or others like us and believe in the opportunity to outperform, to protect on the downside and all those benefits. For that type of client, it's very easy to see. Are you getting that, but you're a little bit lower cost, more tax efficient? Makes a lot of sense. Sure, there are going to be other clients out there that historic 100% passive users, and that's where there's an educational gap, or it's just not going to be the right fit. But for a large client base that uses active or a combination of active and passive, I think it's a very compelling value proposition.
Absolutely. And like we discussed earlier, education is a huge part to getting clients comfortable with these products, paying the higher management fees if there are there, because of the product you're offering, like Brian talked about, being able to put something that wasn't normally accessible to an investor in an ETF structure is an innovative way to provide them with that exposure. And obviously there is a cost associated with that, but if you're able to get that exposure, then it benefits both the ETF sponsor as well as the end client. So we'll end it just on staying on that front, on the education front, which is years ago it was more conversations where you're talking to clients and it was screen liquidity versus underlying liquidity. And I think with the different conferences and the different discussions that we've had, it's evolved into more intricate and I would say tougher questions. So what kind of questions are you getting from clients now in 2022 about your various different products and the ETF ecosystem in general? Anyone want to take that?
Well, I mean, the client has been pitched on, it's about the underlying and not the ETF. Not everyone believes it. And, I happen to think that, the ETF liquidity, is important because it's their order. What happens here? And, I'm not going to assign a 100% probability to good execution because it doesn't happen all the time. But I think dialogue's important, and I think it's important to make your case. But it's also important as an issuer to say, hey, anything can happen because we reference this in other some other panels, especially as a new issuer. Those first few executions are key. A bad experience is really just a tragedy because people talk, and everyone in the marketplace knows when there's a bad print. So I think you have to handle it with white gloves.
Yeah, and the bad prints happen to institutions that should know better as well. We'll see it, and it's not just our products. You'll see billion-dollar products that someone puts a big market order in, they just get their face ripped off. You're giving the market free money, the market's going to take it. And the other side of it, but that communication that Fred mentioned is really key. The product that we just launched on Tuesday with a seed of $2.5 million had a $10 million trade that went off at the bid today. It was perfect. And that's, market makers kind of knowing what they're doing, clients communicating and saying, okay, here's where we're going to go. And that's the experience that everyone wants. And that's what, ETFs, everything's on screen, for better or worse, which is great.
Yeah, I think the education, generally speaking, has gotten much better, albeit like capital markets teams and ETF specialist teams are always busy. And that's a great service to have, right, to help clients get more comfortable with the product and understand how to trade. I would also say that I think the infrastructure and support that exists within the broker-dealers has gotten much better over the past decade as well. And even with the major platforms like Schwab, TD, et cetera. So they have now resources, and I think their clients are more aware of the fact that they actually have those in-house resources and trading desk resources that they can tap into, which has helped as well.
Yeah, I'd echo that. I think the education and a lot of the infrastructure has come a long way. A lot of the questions we're getting now are more around the strategies and the underlying vehicle and ETF basics. It's, tell me about how active management can add value for a dividend-oriented strategy, and we can talk about some of the biases that the passive strategy benchmark might have, or about how to use an ultra-short duration portfolio within the context of the portfolio. So we're having more of those conversations than the ETF 101 types of discussions.
And I think from the broker-dealer side, you're talking about it from capital markets and from the sponsor side. It's all one big interrelated ecosystem. So the broker-dealers, Chris talked about it earlier, want to make sure that everyone has a good experience, because ultimately it is a ecosystem that people do talk, or a product could be adversely affected by a bad print or something. So we are all looking out to make sure that it works in a symbiotic way, such that the assets continue to grow, the end client has a good experience, and then there's liquidity that we can provide. So I actually just got the sign that lunch is ready, so I'm going to open it up for questions, and we can have questions right before we break.
Hello. Hi. You mentioned that some of these active funds are outperforming passive funds. Do you have tickers for any of those?
I guess.
Who's that to?
Anybody on that panel?
Not at the moment.
PFIX, that interest rate
Miss-
hedge, is beautiful.
I missed the last word.
Can you repeat it? What tickers are outperforming?
Somebody said that active ETFs, some of these active ETFs are outperforming their passive counterparts or similar strategies. And I was wondering if you could give us some tickers on that.
The other one, I'm just going to be a ticker, I'm not going to say it.
PFIX is doing well. But it's,
PINK, which is an active healthcare strategy that Simplify manages, outperforming whichever healthcare index you're looking at, outperforming handily. It's
could you repeat the ticker?
PINK. And it's so this is our view. This is our version of impact investing. It's not ESG, but I would consider it SRA. It's we give 100% of the proceeds to Susan G. Komen. So beyond custody and exchange fees, we're giving 100% of the proceeds to Komen. We presented them with a $100,000 check about a month ago. That will grow by the end of the year, but that's been a phenomenal partnership for us and a great way for us to give back. Mike Taylor, who used to run the healthcare book at Citadel and Millennium, is running this portfolio pro bono. It's a really cool strategy, and PINK, very memorable ticker.
So that was a question.
Careful.
Yeah, no. I think cannibalization comes up almost in like a negative connotation, and I don't look at it that way. I look at it as actually a additional choice for our clients and the ability to retain assets. And this year's a really good example, right? Like, typically there's a catalyst for money to be in motion, right? Like a client's not just going to randomly like, hey, you guys have an ETF, we're just going to sell our position in the mutual fund and buy the ETF. Yes, more I think are looking at future allocations towards ETFs, so you could kind of call that cannibalization, but ultimately, if we weren't providing that, the ETF exposure, that money was probably leaving T. Rowe Price. This year's another good example in terms of like capital gains and tax loss harvesting, where we are seeing clients coming from other mutual funds or other ETFs into our ETFs, and even from our mutual funds into the ETF version, where you can maintain a similar exposure, basically reset your entry point, et cetera, and harvest the tax loss. So I think that's an education internally where we did bake in, though, like, look, this is somewhat defensive, but I think the flip side of that, there's a lot more offense. And I think for T. Rowe Price looking forward, and for, I would assume other asset managers are thinking the same way, if there is a growing preference for ETFs, we want to ensure that we're providing our strategies and our capabilities through a vehicle that meets the client need.
Yeah, if you don't cannibalize yourself, someone else will. That was a quote that came up a lot in those conversations with our management team. I think one thing we had to stress was, we're not pricing these at 5 basis points. We're not going from our current fee down to 5 basis points. We're trying to be Vanguard. We're pricing them a little bit narrower margins, and we get some structural cost benefits from TA costs that are a little bit lower. But we'd much rather keep those assets in-house. And there's also, I agree with Tim, there's also a lot of offense. We've talked to clients that say, we love what you guys do on the mutual fund side. I have these ETF models. If you come out with an ETF, we might be able to do that as well. Yes.
We talked earlier about the gatekeeper boogeyman. Have any of you guys on the active scene seen them try to get platform fees for your active products? And I'd imagine they're going to try to defend that. Do you think that they're going to evolve that way eventually?
The platform fees?
Like some TA fees?
So for a mutual fund, you pay to be on XYZ bulge brackets platform, and sometimes they take part of your management fee as well.
Yeah, we ran into that as well. I may or may know who you're talking about in particular, but I think what's just kind of interesting about the evolution of the NTF platform is that it was originally subsidized by the mutual fund complex, and all the ETF issuers just kind of snuck in and had a little party at their expense. Now, legacy asset managers enter the universe of ETFs, just generally speaking, but platforms in particular, and the other side of the table sees dollar signs. We have one of those already, but so we don't need it. But if you want to pay us, we'll take it. So yes, we're running into that.
I do think that will continue to evolve. It's going to be hard for them to give up the mutual fund cash grab, and you might see it as a data charge or some sort of transaction fee unless you pay to get on no transaction fee platform, but I think that is the way things are trending.
When you guys are talking about the cloning issues, from your active mutual funds to your ETFs, are you guys running into any operational or compliance nightmares? For example, if you have redeems in the ETFs or buys and subscriptions in the mutual funds, are there any operational compliance issues you guys are running into, especially when you're trading off the same desk?
I'll take this one since I'm not on the mutual fund side anymore. They're separate vehicles, right? So they're separate trade desks. And the one comment on the cloning, when I was at my last shop, we had Bond, the total return ETF, and the gatekeepers were okay with it because of the moratorium on derivatives and other differences between the mutual fund and the ETF. They were okay having the what was called the total return ETF and the total return mutual fund because they were different. So they wouldn't have to justify, okay, well, this is the same thing, is one better than the other. When the SEC lifted the derivatives moratorium, the guidelines of that fund aligned with the mutual fund, which created major headaches, not on the asset management side, but at the gatekeeper side, because then they were forced into making some sort of call. Okay, well, we have the two of the same product. How can we recommend one versus the other? And so the response was, okay, well, let's change the guidelines to something else, right? So then you went back to having kind of two different vehicles. But as far as like the same vehicle, having two different vehicles trading on the same desk, if you think of any asset manager, think about how they think about separate accounts, institutional accounts, mutual funds. They're all they've got a process, right? So this is just another account with its own distinct guidelines. So there's really nothing weird about it from mutual fund to ETF. It's the compliance structure at these firms is really robust.
Yeah, and that's what I was referring to earlier when if we're trading in and out of a name in the ETF, that's not just necessarily happening within the ETF. That's happening at the portfolio manager level and all the sub-strategies that are underneath that. That almost becomes more like an accounting thing and allocation across the different vehicles, SMAs, institutional accounts, et cetera. So there's no real issue. I mean, yes, there's a lot of compliance and legal infrastructure that exists within the firm and is applied to ETFs, but that specific issue hasn't raised any concern.
It's just another account.
Yeah.
All right, well, thank you very much to our panel, Brian, Tim, Matt, and Fred. Appreciate your time. Thank you to ETP.